Hello everyone, and thank you very much for joining us on Wealth Matters for Physicians by Altfest Personal Wealth Management. I'm Mike Prendergast, a director of Altfest's Healthcare Practice Group and the host of this channel, which focuses on providing key investing and personal financial planning insights to help physicians achieve their important financial and life goals. In this video, we'll discuss how to navigate your portfolio in today's environment of high inflation and the Ukraine crisis. We'll dive into how the US economy is doing right now, what factors are causing inflation to rise to the highest level in decades, why now having a traditional stock and bond portfolio might not be the best way to go, and what types of investments we think are currently good for portfolios given the present volatile and inflationary backdrop. Before we introduce today's guest, a few words about Altfest. For nearly 40 years, Altfest Personal Wealth Management has been helping physicians holistically optimize all areas of their personal financial lives in a fully objective, fee-transparent manner, while as a fiduciary always putting their best interests first. We are honored to be the preferred wealth manager for members of the Medical Society of the State of New York, the preferred wealth management education provider of both the New York chapter of the American College of Surgeons and the New York State Society of Orthopedic Surgeons, and a corporate partner of the Medical Society of New Jersey, amongst other associations. Our guest today is my colleague Mayukh Poddar. Mayukh is an investment strategist and portfolio manager at Altfest Personal Wealth Management, where he focuses on managing and enhancing Altfest's active investment strategies. He's also a member of the firm's Portfolio Action Group, which sets the investment strategy for client portfolios. Before joining Altfest, Mayukh was a proprietary trader at RBC Capital Markets and a founder of his own firm, which advised hedge funds and money managers on high-risk adjusted return strategies. Mayukh has also worked at Goldman Sachs and D.E. Shaw and has both an MBA and a master's in computational finance from Carnegie Mellon University. This is the first of two videos with Mayukh Poddar on navigating your portfolio in today's inflationary and volatile environment. I think that you'll find Mayukh's insights on the economy and the markets and some ways we are effectively handling them in physicians' portfolios very beneficial. Mayukh, thank you very much for being with us today on Wealth Matters for Physicians.
I'm glad to be here.
We're very happy to have you here. Before we get into the details of the investments in today's environment, just so that our physician audience can get to know you a little bit better, what got you intrigued about investment management, investing in the first place?
It's a bit of a long story. So I actually came to investment a bit by chance. So my undergrad was in computer science. So my first job out of college was with a hedge fund called D.E. Shaw & Co. And I was building more trading systems for them at the time. And then I moved on to Goldman Sachs, worked a few years for their investment management division, building different kinds of portfolio and risk analytics. And that's when I started to get very interested in the field. And later I did my MBA and master's in computational finance, came back to the industry, worked as a trader for a few years. And throughout the whole journey, I felt that within the industry, there are a lot of different roles and a lot of different things to do. But what really interested me a lot most was managing investments and trying to make sure that when you manage portfolios, how do you think about risk, how do you think about returns, and then trying to deliver a consistent return profile to investors over time. While it sounds something that should be easy to do, but in practice, it's actually a very hard thing
Very
to
difficult.
do. And it's very challenging, but I find it very exciting as well because if you're able to do it, it's very satisfying too.
Excellent.
Both for me and for my clients.
Great. So Mayukh, could you please give us a quick snapshot of the US economy and the markets, how things are going right now?
So if you look at it at a very high level, the economy seems to be in a good place right now. So there are lots of different data points that you monitor when you're looking at the economy, trying to understand how things are going and how it's likely to evolve from here. And one of the most important data points is obviously the economic growth or the GDP numbers. Now, if you look at the GDP numbers, in Q4 we had a GDP of about close to 7% real GDP, which is absolutely great. If you look at the past, since the great financial crisis, GDP has averaged a little over 2% real GDP.
Right.
And during COVID, of course, a really sharp decline, a very large decline, and then a sharp rebound. And since then, GDP numbers have been moving or staying at a very elevated level, which is really good news for the economy. So that has been going well. Now, if you look at labor markets, unemployment rates are at historic lows. If we look at wages are growing at a little over 5% a year. And I think the interesting thing about wages is that this cycle, what we are seeing is that the wage growth is really highest for the people who are at the lowest quartile of earnings. So really the low wage earners are seeing the biggest benefit of the wage growth, which we believe is actually really good for the economic health. So those things are looking very well. If you look at businesses, their profitability, that's also running at record highs, again, much higher than the average level we've seen since the great financial crisis. The area of concern right now for the economy is inflation. So inflation is running at around 8%, and that's really numbers that we haven't really seen since 1982. And so we can discuss about the dynamics of why we are here, but that's really one of the areas that we find is it's kind of the concerning area. And once inflation started picking up in 2021, the policymakers had kind of had a belief that, well, it's all related to supply chain disruptions, and
Right.
as the economies open up, as supply chains come back, then those bottlenecks will dissipate and inflation would, as a result, come down. But unfortunately, we haven't really seen that. And what it really means is that now policymakers have to really think about how to control that inflation. And that really means that we have to be a little more cautious going forward in terms of how all these variables that we're seeing right now are in a really good place. How they evolve over time is now the real question.
Great. Let's talk a little bit more about inflation. So Mayukh, we've had recessions before, but what's different about this coronavirus recession, and how has that impacted inflation?
It's a great question, Mike. So traditionally what happens during a period of recession is that we see economic activity come down. Typically what you see at the beginning of recession is that credit tends to be very high. We see defaults start increasing, and as a result businesses start cutting production, they start cutting people, we see unemployment go up, income drops, and as income drops, consumers spend less. That reduces profit for businesses, and that cycle continues for some time.
Right.
So there needs to be an adjustment where the total level of production comes down, the level of credit gets adjusted down. And it's really when the level of credit gets adjusted down that you start seeing the recovery take shape. So it's a painful process. There are bankruptcies, job losses, loss of productivity, loss of income. But at a certain point, things starts to recover and you get back. Now, what is so different about the COVID crisis is how policymakers reacted to this crisis. So generally, typically what happens is that when we enter a recession, Federal Reserve cuts interest rates or adopts more loose or stimulatory monetary policies, and that helps with the recovery process. But that's a gradual change that we see happening. What we saw this time during the coronavirus crisis is that the Fed and the Federal Reserve and the federal government both stepped in with like extraordinary measures.
Right.
So Fed cut interest rates to zero. For the first time in history, they actually started extending credit directly to businesses. The government instituted the PPP, which was launched for businesses, and then their unemployment benefits were increased and direct transfer payments were made to consumers. So what really happened there is that unlike any other recession, what we saw during this recession, because of all of this government spending, the increased unemployment benefits and direct transfers, PPPs and other credit support mechanisms, income for consumers or households actually increased.
Actually
increased during the coronavirus recession as opposed to coming down. And what did people do with that increased income? They paid down debt, they increased their savings, and then they spent. Now, because of all the lockdowns and other health issues, service spending actually came down. Like people were not restaurants were closed, and then even if they were open, people were hesitant to go.
Sure.
They're hesitant to travel, so there were some restrictions. Plus, for health reasons, people had cut down on all of the spending.
Right.
So they actually started spending a lot on goods.
Right.
We had this whole shift towards work from home. That meant a lot of spending on devices and technology and infrastructure, both by companies and households, to be able to do that remote work properly. Now, if you contrast that to how businesses reacted more or less like a traditional recession, right? When they saw that a recession is coming, we're going to have these lockdowns, loss of income, and all of that. They cut down people, they cut down production, they cut down productive capacity. So essentially, productive capacity went down, income went up, and spending went up. So that led to a big divergence between demand and supply. And as a result, prices started going up, and that's at a very high level, that's what drove the inflationary impulse that we're seeing right now, and why we have such high inflation right now, as opposed to all of the other recessions.
Thank you. So then, Mayukh, when you add in the Russian-Ukraine situation, how has that increased the inflation dynamic?
So that has played a very. So I think if you go back a little bit in time, like if you go back to 2021, mid 2021, when the Federal Reserve was kind of talking about inflation as a transitory phenomena, people are thinking about supply chain bottlenecks to come down as COVID cases come down, economies to open up, productive capacity to go back, and inflation to come down. It didn't really happen, and one of the things why inflation had persisted at such a high pace was that there were these second and third waves of COVID of different variants.
Right.
So the unclogging of the economic pipelines or the supply chains didn't really happen as fast as people were anticipating them.
Right.
The other thing that we saw during that period was that energy prices, all kinds of commodity prices, not just energy, materials, minerals, metals, all of them actually persisted higher and continued higher during the second half of 2021. So if you think about the energy complex or the commodities complex, we had this commodities bust in 2015. And since that time, if you look at how much different companies are spending in capital expenditure, energy companies or metal and mining companies or mineral companies, that capex spending has actually gone down a lot. So essentially, the productive capacity within that sector has reduced a lot. So, and if you think about the energy sector, some of the things that are interesting is like if you look at natural gas. US is one of the largest producers of natural gas, and we have actually capacity to increase production and produce more. And Europe and Asia are large importers of natural gas. Right. And if you look at natural gas prices in Europe and Asia, they're much higher than in US. So natural economic forces would dictate that we produce more out of US and export them to Europe and Asia, where it will relieve their energy crisis as well as earn income for our producers in the United States. But why isn't it happening to that extent? Because this infrastructure for kind of taking natural gas out of the US and shipping it out to to Europe and or Asia requires infrastructure that requires at least 3 years to build out. For like, you first have to liquefy the natural gas, ship it out as liquids, and then the liquid has to be accepted and processed on the other side,
right,
and converted into gases again. So all of these terminals, this liquefaction terminals, LNG terminals, they require 2 to 3 years to build at least. So essentially, there is a lot of this investment, underinvestment. We saw capex staying low, and then this whole complex had been suffering from underinvestment, and they haven't been really able to ramp up production. And obviously, there was an OPEC decision where they decided to show a lot more restraint on how they produce, and that has also kept those prices high. Now, how does Russia and Ukraine play into this? So Russia and Ukraine together they're a bloc that is one of the largest commodity producers for various commodity markets. So if you talk about grains, about a third of food grains like wheat, corn are produced in Russia and Ukraine. Mm-hmm. And so a big part of the world, especially parts of Africa and Asia, they kind of consider Russia and Ukraine as their breadbasket.
Right.
So obviously, any conflict there, uh, any reduction in production, or any kind of inability for them to ship their goods, is going to be harmful. Similarly, if you think about fertilizers, this region is one of the largest producers. Belarus is the largest producer of fertilizers in the world, and now they're under US sanctions that reduces their ability to finance international trade. And similarly, Russia is also under US sanctions, and that reduces their ability to access international markets. And if you talk about energy, Russia produces about 10% of the world's crude oil. They supply about 40% of natural gas that goes into Europe, that Europe uses to produce electricity. Now, what we have seen in terms of the response from US and Europe, US has, for example, banned Russian crude oil and Russian energy supplies, whereas Europe has said that they cannot afford to do it. They're strategically decided that they will not ban Russian oil and gas because without it, their economy is simply going to collapse. So there's all this dynamics that's going on, but if the conflict continues and we don't see a resolution in time, then Europe might actually have to consider banning Russian oil and gas, and that will actually exacerbate the current energy crisis that's going on in Europe. So Europe has, if you look at energy prices, electricity prices, natural gas prices in Europe, they are at least more than 2.5 to 3 times the comparable prices in the US. So that their economy is actually suffering a lot from this conflict, but as the conflict continues, it's going to keep that pressure higher. And if the geopolitical situation worsens to a place where Europe has to put sanctions on Russian oil and gas, then that's going to really exacerbate and create a huge energy crisis for the global economy.
Thank you very much, Mayukh. So you've touched on it, but giving it a little more meat, why is inflation such a big concern right now, and why is the Federal Reserve really trying hard to tamp it down?
That's probably the biggest question right now for the economy. Let's break it down into 2 parts.
Right.
So first, let's talk about why is inflation a big concern. So if you think about why policymakers are so concerned about inflation, the primary concern is that if we have inflation, so we have businesses that are increasing prices because otherwise their profits will come under pressure. As their input prices go up, they increase the prices they charge consumers. And then as inflation continues to be high, then workers, they need to maintain their living standards, they need higher wages. So they demand higher wages.
Right.
And that increases the cost for the business. So what policymakers or the central banks are really worried about is this spiraling into a situation where inflation causes higher pressure on wages, especially because the labor markets are very tight right now.
Right.
We are at historic unemployment rates. So labor has a lot of bargaining power at this moment. So if inflation continues to be really high, the labor costs will continue to go higher because of all the factors we've just discussed. And the increasing labor cost will again feed into higher prices as businesses trying to maintain their profitability is going to raise prices. So it can go into a kind of a spiral where inflation becomes a more persistent phenomenon or a feature of the economy.
Right.
And that's really not an area or a place where the central banks would want the economy to go to, because if inflation becomes a really persistent phenomenon, people start to lose faith in the currency. Obviously, the US currency is a very, it's the global store of value. It's globally accepted currency.
Right.
So it's not such a big concern right now, but obviously policymakers don't want it to become a concern for the economy, and that's why they're thinking about ways or mechanisms to tamp it down. So what can policymakers do to tamp down inflation? So if you look at inflation, the reason we have the high inflation is the divergence between demand and supply. Mm-hmm. And ideally what happens in a situation where prices are going up because demand is strong and supply is not sufficient to meet demand, the profits for corporations are going up, and that should incentivize companies to come in and do more capex, expand their production capacities to meet the demand.
Right.
But as we discussed earlier, it takes time and a lot of investment for this supply side response to come in. And the worry for policymakers is that by the time that supply response comes in, inflation might already be embedded at a very high persistent rate. So what policymakers can do to tamp down inflation is really try to get the demand side of the equation down, which means they're trying to get consumption down. So how do they do it? They do it by increasing interest rates, by making credit harder to get, and they're also going to shrink their balance sheet, which means that they're going to sell assets. And when they're selling assets, they're absorbing cash or liquidity from the markets. And all of this makes access to financing hard, and that has a demand destruction or an effect of lowering demand. So essentially, what policymakers are trying to do is trying to get demand to come down to meet supply. And that essentially means, what it means for us is that it's going to put pressure on economic growth. It's going to push the GDP downwards, and we're essentially most likely to go into a period of slower economic growth. But that's essentially the most effective tool that policymakers have. But that's the likely outcome, that you might end up with slower economic growth.
Well, thank you very much, Mike. That's a lot of nice, deep context as to what's going on right now. Inflationary environment, like you said, supply and demand. So given that, how do you see portfolio construction right now? Is the traditional stock bond portfolio, which has served people well many times in the past, is that the current way to go, or maybe there would be something different?
So that's an excellent question, Mike. So if you look at the traditional equity bond portfolio, it has served people really well for the past 40 years, right? We have had really strong returns, and then the bond portion of the portfolio has kind of acted as a buffer against risk, or for periods where we see equity drawdowns or equity market volatility. Bond markets have actually done better during those periods, kind of buffeting the whole portfolio, providing it stability.
Right.
So it has been a really great mix. But if you look at how the economic scenario situation has been for the past 40 years, is that we were coming out from a period of very high inflation to low inflation, high growth. And during periods of high growth, the equity portion does well. And as inflation comes down, interest rates come down, bonds do well. So we had kind of a golden era of an equity bond allocation. Now, as we go into this new environment where inflation is high and the policymakers are really trying to take steps to tamp down inflation by increasing interest rates, that dynamic, in our view, changes a lot. So in an environment where interest rates are going up, and based on what the Fed has told us, they're likely going to continue increasing rates until inflation comes down, which means until the demand side comes down and we see slowing economic growth. So until those goals are accomplished, the Fed is kind of determined to keep raising interest rates.
Right.
And in that environment, we don't anticipate bonds to provide that traditional role of buffeting the portfolio during periods of equity volatility, because interest rates are unlikely to go down in this scenario, because Fed is on a path of raising interest rates, so that will keep pressure on bonds. So that makes a traditional equity bond portfolio a little less robust than it was in the past. And so from that point of view, we think that it's prudent to include alternatives in the portfolio, alternatives that can actually provide that risk mitigation characteristic that bonds used to be able to provide earlier in the portfolio. And that becomes much more important in this current environment.
This is the end of our first video with Mayukh Poddar. Please join us for the conclusion of our interview with Mayukh Poddar in our next video. If you would like to receive a complimentary review of your investment portfolio, or discuss anything related to your investments or other personal financial planning matters with an Altfest professional at no obligation, please contact my colleague Jesse Freeling at 212-406-0850, or by emailing Jesse at his email address, which is in the description of today's video below. If you like this video about providing insights to help physicians optimize their personal finances, please click the subscribe button and hit the bell icon below so you can receive notifications each time we release a new video. If you think that a fellow physician would find this video interesting or useful, please feel free to share it with him or her. Lastly, as always, this channel is for you, and we want to make it as useful and as enjoyable as possible. If you have topics you'd like us to cover in future videos, like or dislike certain things that we're doing, or just have any other feedback, we'd love to hear from you. So please feel free to share your comments with us in the comments section below. Thank you very much. Well, that's all for today, physicians. I look forward to being with you again in our next video. And until then, be well and keep on optimizing your finances.